Okay, get this. DoorDash stock plummets. Seems straightforward, right? Except they just announced record orders and record revenue. How on earth does that work?
Right. It's a bit of a head scratcher.
That's the kind of thing we love to dive into here, and today we're doing exactly that with DoorDash's first quarter of 2025 earnings and their big news, the planned acquisitions of Deliveroo and 7Rooms.
Exactly. And we've got, the full picture here. DoorDash's official numbers, the market reactions from places like the Pinnacle Gazette and StockTwits,
Right.
and even a quick look at Datadog's recent earnings call, just to give us some context on how the wider tech world is being viewed right now.
Ah, okay, good context.
Think of this as us, cutting through the noise to bring you the essential understanding of what's actually happening.
Our mission for this deep dive is pretty simple. Figure out why the market reacted the way it did to what looks like a really strong quarter for DoorDash, why send the stock down, and what do these big moves, these acquisitions, tell us about where the company's headed.
Yeah, let's jump in.
So let's kick things off by looking at the numbers they were celebrating. The good stuff first.
Right. So DoorDash, they definitely led with the headlines of, record performance. In Q1 2025, they processed a record 732 million total orders.
732 million.
Wow. That's an 18% increase compared to last year. Pretty solid growth.
Okay.
They also saw their marketplace gross order value, or GOV, reach a record $23.1 billion. That's up 20% year over year.
20%, okay. And revenue?
Revenue also hit a new high, $3.032 billion. That's a 21% jump from the same period last year.
Okay, those are some seriously impressive growth figures. And it wasn't just about more orders, right? They actually turned a profit, didn't they?
Yes. That's a huge point. They reported a GAAP net income of $193 million.
Which is massive compared to last year.
Exactly. A huge turnaround from the $23 million loss they had in Q1 of 2024. So yeah, a really dramatic shift towards profitability.
That's a big deal.
Absolutely. And the positive momentum, it continues. Their adjusted EBITDA, which is a key indicator of underlying operating profit, kind of strips out interest, taxes, depreciation.
Right, the core business earnings.
Exactly. That saw a substantial increase, too. It rose to $590 million from $371 million in Q1 2024.
Okay, another strong positive then.
Definitely. Plus, their GAAP gross profit also showed really strong growth, up 31% year over year to $1.478 billion.
So lots of green arrows pointing up on the core financials.
For sure.
But here's where it gets really interesting. Looking beyond just the big numbers, it seems like people are, relying on DoorDash more in their daily lives.
That's definitely the picture they're painting. Their average order frequency reached an all-time high.
Okay.
And it's not just, your Friday night takeout anymore, is it?
Sounds like it. What else are they ordering?
Well, they're seeing a growing number of consumers ordering groceries through the platform. And what's particularly noteworthy is that the average amount spent per grocery customer is increasing.
Ah, interesting.
Yeah, especially on things like fresh produce, perishables, that kind of stuff. It suggests, growing trust, maybe convenience that goes beyond just restaurant meals.
So people are trusting them with their bananas.
Apparently so. And their subscription programs seem to be really taking off, too.
Dash Pass and Wolt Plus members.
Yep. The growth in both Dash Pass and Wolt Plus memberships actually accelerated during the first quarter.
Accelerated, okay.
And internationally, they're seeing some really promising trends. Their monthly active users outside the U.S. continued double-digit growth.
That's strong.
And Wolt Plus memberships more than doubled year over year in the countries where they operate under the Wolt brand.
Doubled, wow.
Yeah. And importantly, the growth in total orders internationally is significantly higher than what they're seeing back in the U.S.
Okay, so on the surface, it really does paint a picture of a company just firing on all cylinders, record everything.
Pretty much, yeah.
But then the stock price goes the other way. What gives? What's the missing piece here?
Well, okay, while those headline figures were certainly strong, if you dig into the details, say from the Pinnacle Gazette and StockTwits,
Right, the analyst view.
it reveals that DoorDash actually fell slightly short of what analysts were expecting for both total orders and revenue.
Ah, okay. How short?
Well, the Gazette pointed out that these 732 million orders, just a hair below the consensus estimate of 732.7 million.
Okay, tiny miss.
Tiny, yeah. And the $3.03 billion in revenue was just under the $3.09 billion analysts were projecting.
Still sounds close, but okay.
It does. But even small misses like these, sometimes that's enough to trigger a negative reaction from the market. Expectations matter a lot.
Okay, so a slight dip below expectations. Fine. But it feels like there must be more to it, especially with the announcement of those two really big acquisitions.
You're right, that's a huge part of the story. Alongside their earnings, DoorDash announced these two major strategic moves. First, they've agreed to acquire 7Rooms
7 Rooms.
for approximately $1.2 billion in cash. They expect that deal to close in the second half of this year.
$1.2 billion. And 7 Rooms. Remind me, what do they bring to the table for DoorDash?
So 7Rooms is a leader in technology for the hospitality industry. Think tools that help restaurants manage reservations, understand their customers better for in-store dining.
Ah, so the in-restaurant experience.
Exactly. Building stronger, direct relationships with customers. DoorDash is framing this as expanding their commerce platform capabilities beyond just delivery.
Interesting. So it's not just about getting food to you, but managing things inside the restaurant too.
Precisely. Right now, DoorDash is mostly about fulfilling delivery or pickup. 7Rooms gives them a presence inside the restaurant, potentially opening up new revenue streams, deeper insights into customer behavior across online and in-person dining.
That's a pretty significant strategic expansion then, moving into the tech that powers the restaurants themselves.
It really is.
And the second acquisition, that's Deliveroo, right?
Yes, the second big one, a formal offer to acquire Deliveroo, which, as you know, is a major food delivery platform based in the UK, big operations across Europe and the Middle East.
Yeah, they're huge over there. What's the price tag on that one?
The offer is around 180 pence per share. That values Delivery's equity at about $2.9 billion. Reports put the enterprise value around $2.4 billion, but the total cost mentioned is closer to $3.9 billion US.
So roughly $4 billion US. On top of the $1.2 billion for 7 Rooms, that's a lot of money.
It's a huge outlay, yeah. Both boards have approved it, and they're aiming to close in Q4 2025, assuming they get all the needed regulatory and shareholder approvals.
Wow. Okay, that's a massive move for international expansion. Deliveroo is really strong in markets where DoorDash, well, doesn't have much of a footprint, right?
Precisely. DoorDash's CEO, Tony Zhu, he sounded really optimistic about combining their sort of operating playbook with Deliveroo's local market knowledge to drive innovation.
Makes sense.
It's a clear, very significant step to broaden their geographic reach globally.
Okay, so let's recap. We have a slight miss on revenue and orders, but strong growth pretty much everywhere else. Profitability looks good. And these two really big and presumably expensive acquisitions announced, this has got to be the key to understanding why the market reacted negatively.
I think you've hit the nail on the head. It's the combination. Look at their outlook. While their Q2 forecast for marketplace GOV projecting between $23.3 and $23.7 billion is actually above previous Wall Street forecasts.
Okay, that's all good.
The Pinnacle Gazette highlighted something crucial. DoorDash revised its adjusted EBITDA forecast for Q2 downwards. The midpoint is now $625 million.
And that's lower than expected.
Yeah, below the earlier estimates of around $639 million.
Ah.
So this revised lower profit outlook for the near term, despite the growth in order value, that's a big concern for investors.
Right, so they're growing the top line, but maybe profitability isn't keeping pace as much as the market hoped, especially with these big spends coming up.
Exactly. It's really telling. The market seems intensely focused on near-term profitability right now, even for companies growing fast. Maybe it's broader economic jitters, but showing a clear path to sustained earnings seems critical, even if it means dialing back immediate growth slightly.
So they're still projecting growth?
Yeah.
Just maybe not the profit level the market wanted baked in.
That seems to be the crux of it. And then you factor in the cost of these acquisitions. $1.2 billion for 7Rooms, around $3.9 billion, give or take, for Deliveroo.
Over $5 billion total.
Yeah, that's a substantial amount of capital being deployed. And it naturally raises questions for investors about the immediate impact on DoorDash's profitability and, their cash flow in the short term.
That makes perfect sense. Big spending now for potential future gains always introduces uncertainty, some risk in the market's eyes. What are the actual financial analysts saying about all this? Is it all doom and gloom?
Well, interestingly, no. Despite the stock drop, the Pinnacle Gazette noted that the average price target set by analysts for DoorDash still suggests potential upside.
Oh, really?
Yeah. So it indicates a somewhat divided sentiment. There are clearly worries about the immediate future, profit margins, the cost of these deals.
Yeah.
But a longer-term optimism seems to persist among many analysts. They might be looking at the potential market share gains, the strategic fit of these acquisitions long term, the continued core growth.
Balancing the short-term pain with long-term gain potential.
Kinda, yeah. It's
Yeah.
not a simple picture.
And you mentioned this isn't just a DoorDash-specific situation either, right? The Datadog call.
Right. Just for context, looking at Datadog's earnings call transcript, they also talked about challenges managing growth expectations, navigating market volatility.
Right.
Even companies experiencing strong growth can face, intense scrutiny about their future outlook and profitability. It reinforces the idea that the market isn't just looking at current growth. Future profit and the cost to get there are critical right now.
Got it. So putting it all together, we can see these key strategic priorities reflected in Q1 and these big moves. What were some of those key priorities DoorDash themselves highlighted?
Well, they emphasize several key areas. A major one is just improving their U.S. restaurant offerings. So bigger selection, fewer order errors, faster delivery, better personalization.
The core stuff.
Exactly. They said these efforts are driving consistent year-over-year growth in U.S. monthly active users. So keeping the engine running.
Makes sense. Got to keep the core business strong. And beyond restaurants.
They're actively pushing into multiple new categories. Grocery growth is the prime example they gave of success there.
Right, the bananas.
Right. Broadening geographic reach is another key priority, and obviously the Deliveroo deal speaks directly to that.
Really?
Growing the value of their membership Stash Pass, Wolt Plus is also a big focus. They're seeing good results. Faster growth, more trials, less churn.
Okay.
And finally, the 7 Rooms acquisition fits into their goal of finding more ways to help merchants grow their businesses, not just fulfilling orders.
It sounds like a pretty well-defined multi-pronged strategy then. How does their overall financial health look beyond just the profit numbers? Are they bleeding cash to do all this?
Well, there are some encouraging signs there, too. Their GAAP gross profit as a percentage of their marketplace GOV actually increased.
Okay, better margins.
Yeah. And their GAAP cost of revenue, excluding depreciation and stuff, as a percentage of GOV decreased. They said that was driven by efficiencies in order management, lower insurance costs.
So they're getting more efficient operationally.
Seems like it. They also reported an increase in net cash from operating activities and free cash flow compared to last year.
Okay, so cash flow is positive and growing.
Yes. And remember, the board authorized a pretty substantial stock repurchase program up to $5 billion back in February, though they hadn't actually bought back any shares as of early May.
Right, so it appears they have the financial flexibility, on paper at least, to pursue these big acquisitions.
It seems that way.
What's their own outlook for the near future? What are they telling investors to expect?
So for Q2 2025, DoorDash anticipates their adjusted EBITDA will increase, both compared to last year and compared to Q1.
Okay, sequential and yearly growth in EBITDA.
Yes. And they also expect that adjusted EBITDA as a percentage of GOV will actually improve from Q2 to Q3 this year.
So margins improving later in the year.
That's the forecast.
Oh.
However, they did add some caution. Potential shifts in consumer demand, the international operating environment.
Standard caveats.
Pretty standard, yeah. And they are clearly signaling continued significant investment in new categories and international markets. The spending isn't stopping.
Okay, so let's try and bring it all together then. It's definitely a complex picture, isn't it?
Very much so.
Strong growth in many key areas, huge move into profitability this quarter.
Right, the $193 million net income.
But a slight miss on revenue expectations and, crucially, that downward revision of the near-term profit outlook.
Mm-hmm.
And all this is happening right alongside spending potentially over $5 billion on 2 major acquisitions. So yeah, you can kind of see why investors might pause, maybe get a bit cautious.
Exactly. So for you, the listener, what does all of this signify? Well, DoorDash is clearly in a phase of really aggressive expansion. They're making substantial long-term bets to broaden their market reach, the range of services they offer.
Betting big on the future.
Definitely. The immediate market response seems to reflect this tension, this concern about balancing that ambitious growth with the need to show consistent, improving profitability, right now in the near future.
That contrast really sticks with me. Record numbers of people using DoorDash, more orders than ever, actual profit.
Yeah.
Yet the stock price still takes a significant hit.
Yeah.
It just highlights the complexities of how the market values growth versus immediate profit, especially in today's climate.
And this really raises a crucial question for us to ponder, maybe for you to think about too. Will DoorDash's bold acquisition strategy, spending all this money, ultimately pay off? Will it solidify their position as a dominant force in global local commerce? Or will these short-term concerns about profitability, about the cost of these deals, continue to weigh on the stock? And maybe more broadly, what does this situation tell us about the market's current priorities? Growth at all costs or profitable, sustainable growth?
It's definitely a development to watch very closely as these acquisitions, hopefully close and their impact starts to unfold over the coming year or two.
Absolutely. Lots to keep an eye on.